Hello everyone. Today I'm going to teach about debt market. So basically, our financial market has three parts. Um, First is capital market, second is money market, third is forex market. Inside first capital market, we have two divisions. One is equity market, another is debt market. The debt market inside capital market is for long-term investments, typically exceeding 1 year, and the debt market inside, like which is for more lesser than 1 year, it is referred to as money market. So first, let's look into the debt market, which is under capital market. So capital debt market, they typically exceed 1 year, and uh, like they can be of four types. One can be issued by government, one can be issued by corporates, one are known as foreign currency convertible bonds, and one is foreign currency exchangeable bonds. Now the ones issued by government are can be issued by central government or can be issued by state government. Central government issues G6, and if they are for short term, which is actually a part of money market, they are called treasury bills and cash management bills. And for long terms, it is called bonds and dated securities. And state government issues state development loan (SDL), and this is only for long term. Yes. And now second is issued by corporates, and corporates issue debentures under the SEP market. Third is foreign currency convertible bonds (FCCB). These are hybrid of debt and equity. Basically, debt to equity conversion into a share of the same company is present, and also the payment of the uh, like the mm, payment of the interest is done in foreign currency. Now, last is foreign currency exchangeable bonds. These are also hybrid of debt and equity, and debt in equity conversion is present there, but it like that conversion can be also in shares of a different company. And similarly, here also the payment is in a foreign currency. So these were the four kinds of uh, i- issues in a debt market. Now coming to money market. This is basically short-term debt market. So this exists for 1 day to 1 year, and this can also be issued by government, issued by corporate, and third is others. Now, first is issued by government. Government can issue two types of debt instruments. First is T-bills, treasury bills, and second is cash management bills. Uh, Treasury bills, these are only issued by central government, and they have three kinds of maturity period: 91 days, 182 days, and 364 days. Firstly, the T-bills are issued at a discount, and hence there are no coupon payments. Uh, and the denomination of T-bills is minimum 10,000 rupees, and its multiples there. Yield of T-bills is calculated by face value minus the issue price divided by issue price into 100. And also, um, T-bills are eligible for counting of SLR, and since they are issued by central government and they are safer, they provide lower return. Settlement of the T bill is made on the T plus 1 day, like the T is the trade day and plus one being the working day right after the trade day. So that is all. Now, types of T-bills. There are on-tap bills. On-tap bills basically mean bills which are there to fulfill immediate cash needs. Ad hoc bills. These are there to maintain specific cash balance, and these were abolished in 1997. Auction T-bills. These bids were collected from different investors in RBI retail platform, and auction is yield based or price based. Investors submit which price they are willing to accept, and then in that in that price, those bills are sold. Now, second kind of bills are cash management bills. These are same as T bills, but they have maturity even lesser of 91 days, and their date is also of T plus 1 days. And it is not actually appropriate if you want funds for 91 days, because the settlement date will be um, like actually for 91 days, like the settlement they will be for lesser than like the last um, A trade day will be for maximum 90 days. So for 91 days, you cannot keep the fund. Now, next kind of instruments in the money market is issued by corporates. One kind of issuance by corporates will be certificate of deposit, CDs. These are actually offered by banks or financial institutions in electronic form or written note. These are specifically issued by four kind of participants like scheduled commercial banks, RRBs, small finance banks, and all India financial institution. We have to remember this. Scheduled commercial banks, SCBs, RRBs, small finance banks, and AIFIs. Now, the minimum amount of CDs is 5 lakh and its multiples. And maturity for this is between 7 days to 1 year for banks and 1 year to 3 years for AIFIs. And loans cannot be granted against CDs, and these are issued only in demat form, and settlement is again in T plus 1 days. And these can be of two types, negotiable and non-negotiable. Non-negotiable can be sold before maturity with a lower interest rate. Okay, now that is all. Next are commercial paper or unsecured promissory notes. These are the borrowings which are not backed by any collateral, and companies, primary dealers, and AIFIs are eligible to issue this, but net worth of companies should be minimum 4 crores. This have a time period of 7 days to 1 year and minimum credit rating of A3 by any credit rating agency should be there. And these are also in DMAT form and minimum of 5 lakh should be there and its multiples. And these are also issued in discount. That is all. Okay. And also buyback of commercial paper is allowed after 30 days from the date of issue. That is all. Next are commercial bill, trade bill, or bill of exchange. These are actually the bills in which a drawing company uh, uh, gives the bill to the drawer company, and the drawer company then gives it to the bank, and hence the bank gets the money from the drawing company on maturity instead of the drawing company. Like for example, if you owe some money for to a bank now, no, like if you, for example, if a drawing company gives you the bill and says that they will pay you in this date, but then you want immediate fund, then what you do, you give this commercial bill to the bank, and then that bank on maturity collects that amount from the drawing company, and meanwhile bank gives you the required amount whichever you want immediately. So that is what happens. And two types of commercial bills is there. First are demand bills. These are the bills which can be paid on demand, and issuance bills. I think it should be issuance. These are paid on agreed date. Next are intercorporate deposits. These are actually unsecured lending by one corporate to another, and these are uncollateralized. Hence, they are much more risky, and also if they are risky, the return is also higher. Now, fifth is call market. Call market basically banks borrow from one another, and this is called call money market, like call market, and they can be of yes, three types. In call money market, it happens. This borrowing happens overnight, except holidays. In notice money market, it happens from 1 to 14 days. In term money market, it happens for more than 14 days. And here the like the security is given by CCIL. It brings market stability, and the CCIL for call market is NDS call. Now, last is collateralized borrowing and lending obligations, CBLO. These are for non-bank entities, and lender and borrower use collateral, and this was actually discontinued in 2018, and it was replaced by tri-party repo. So basically, there were six kinds: certificate of deposit, commercial paper, commercial bill, intercorporate deposit, call market, CBLO. Okay. Yes. Now, the third kind of that in money market is others. Others have six kinds, and again, first is repo transactions or ready forward transactions. This is basically funding by selling a security held on spot basis and repurchasing the same in forward basis. Like in repo market, what happens that I sell you one of my stuff and you give me money, and after so I promise that on maturity I will pay this much money for that stuff and you will give me back. You will give me like that item, you will give me back. So this is what is the crux of repo transactions. Repo market is regulated by RBI, but the procedure and mechanism of settlement, everything is done in secondary market. So that part is regulated by SEBI. It is useful in case of low liquidity in the market to counter economic slowdown. What will happen that I will give you my securities and you will give me liquidity money. So this is how RBI regulates liquidity in the market. And also, even like I promise that I if I give you securities worth 100 rupees, but still you will give me I think 75 rupees. Whatever 25 rupees you are keeping, that is called the haircut amount. This amount is kept by the lender while giving the loan because in case I default, then that lender can recover the amount from that 25 rupees and the securities which I have kept. So the lender can recover the amount from haircut and GSEC. Now there are three types of repo. First is overnight repo or call money. It happens overnight. Term repo and notice money, I think, yeah, it happens 1 to 14 days. And one third is open repo. It happens for more than 14 days. Second is reverse repo rate. It is again repurchased by RBI in case of excess liquidity to counter inflation. RBI gives securities and takes away liquidity from the market and to balance excess liquidity in the market. This is done to counter inflation. Third is standing deposit facility (SDF). This is same as reverse repo, but this happens without any collateral, and this was introduced by RBI on 8th April 2022. Fourth is Market Stabilization Scheme (MSS). This was introduced on April 2004 to suck out excess liquidity by selling government securities called market stabilization bonds, and money obtained by this is kept in a separate bank account so that government doesn't spend it and infuse liquidity again. Fifth is tri-party repo. This only allows GSECs to act as a collateral. This came as a replacement for CBLO, and in CBLO private bonds etc. were also allowed, but here only GSECs are allowed, and there are three parties involved in this: borrower, lender, and mediator. The last is long-term repo operations and targeted long-term repo operations. LTRO, long-term repo operations. This actually happened during COVID-19 to inject liquidity. This is same as a repo rate, just this is for longer period, like from 1 to 3 years. And like as this is for longer period, this is not a part of money market. And TLTRO is also not a part of money market as it is for long term. And in this, the central bank incentivizes banks to lend to a specific sectors to ensure liquidity reaches the targeted sector. Like in case some sector is lacking liquidity, then this is used. Uh, that is all. Now, that is all about, I think, the capital market. And now, next is gilt securities account. Gilt securities accounts are the accounts for individual retail investor and RBI retail direct to participate in GSET market. This should be remembered. Now, what is the NDS OM? Negotiated Dealing System Order Matching. This is actually owned by RBI and this is maintained by CCIL. All buying and selling orders are matched and then orders are transferred accordingly by this system, and this only works in the secondary market, and this was launched in August 2025, no 2005. Negotiated dealing system order matching. By the name only we can understand what it is. Now, eCuber actually helps in primary market, and it is also owned and maintained by RBI. Earlier, like the NDS was owned by RBI but maintained by CCIL, but eCuber is owned and maintained by RBI, and this allows RBI to connect with different banks 24 into 7. Now, what are primary dealers? Primary dealers are basically registered entities with RBI who have license to purchase and sell government securities, aiming to resell them to buyers. Now, let us look into some of the reference rates. Like reference rates are basically the benchmark for international lending interest. Now, they can be like earlier LIBOR was used, but then it was I think um, got involved in some kind of scam or something. That after that LIBOR was abolished, but till now any substitute for LIBOR has not been finalized. I think our Indian government is looking after MM FIOR, but still it's not finalized. And the interest rate is calculated as LIBOR plus the spread amount. LIBOR was London Interbank Offered Rate, MIFOR, Mumbai Interbank Forward Outright Rate. Like in India, I think MIFOR was used, which was basically calculated based on LIBOR. Since LIBOR was involved in, I think, some scam or whatever, then MIFOR was also scraped out. SOFR is security secured overnight financing rate. This is used in USA for USA and MMFIOR modified MIFOR. This is based on SOFR. SONIA sterling overnight interbank average rate. This is used in UK. ESTR euro short term rate for Europe. SARON Swiss average rate overnight. This is for Switzerland. And Toner Tokyo overnight average rate. This is for Japan. That is all for debt market and money market. Now, next one will be forex market. This will be in the next video. Thank you.